This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of October 29th. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Hello, Patrick. How are we looking today in the markets?
Big 2 weeks. We kind of gave a hint to this last week. We're going into earnings season in the U.S. What that means is we get a look at the Magnificent Seven. So the big U.S. tech stocks. We get Microsoft and Google and Meta. Then we get Amazon. We get Visa. So important names, as we've kind of talked about before. You know, I'm a big believer that earnings drive stock market returns. And I'm specifically interested to see what we get out of Visa and Amazon, because I think these are businesses that are kind of in the eye of the storm with regards to the new tariff policy. We're expecting double-digit earnings growth off of Amazon. Amazon's been kind of quiet this year, up only about 4% year to date in US dollar terms. That's a big deviation from its past 5-year average rate of return, which is almost 50% a year for the past 5 years. So if we see any kind of weak guidance come out of either of those two businesses, you know, it'll certainly impact the market. I think the other big notable is on gold. So, you know, we've been talking a lot about gold and Bitcoin. Gold had just been on this, you know, amazing run, but well off its highs. So, you know, kind of looking at the last month, down about 10%. So we've kind of passed through that $4,000 US mark, where before we were at about 43.50. I still like gold. I still think that central banks globally are still going to be in gold buying mode, but perhaps a little bit more balance between supply and demand. So nothing yet to kind of panic on the front, but certainly interesting.
Very good. We have our first invited guest, our first official guest on the Wealth Roundup podcast. Would you like to make the introduction?
I sure would. So we're really lucky to have Duran Guest from BMO Global Asset Management. She's the Vice President of Alternative Investing. I've known Duran for a really long time, and I consider her an expert when it comes to innovative investing ideas. I'm so really glad to have her here today.
All right. Well, let's start there. Let's start with alternative investing. How would you describe, Duran, alternative investing?
Yeah, so definitions of what constitutes an alternative investment can vary considerably, especially as our industry grows and evolves. Alternative investments were originally only accessible to institutions, endowments, pension funds, those really large groups of investors. But now they've become readily available throughout the advisor channel to a broader range of investors. But that being said, to stay within scope of what we're talking about today and the alternatives that we're speaking about today, I would define an alternative as an investment that does not trade on a public stock exchange. So that would include something like the TSX or the New York Stock Exchange. And this can include private equity, private credit, real assets, which would include real estate as well as infrastructure, and then as well as hedge funds. Lastly, alternative investments have the flexibility to be long, use derivatives, so such as options or futures, and they can also take short positions or use leverage. And so due to this flexibility that alternatives or private markets strategies can provide, it's really important to know the inner workings of each different fund or strategy and the manager that's conducting those strategies as well.
And when we're talking about public and private investments or markets, how common are they and how much money is involved with these?
Yeah, that's a great question. So even though the concept of private markets and alternatives can seem quite new in our channel and in our world, within the Wealth Advisory channel, some of these companies, these private market companies, have been around for 20, 30, or even more years. So all of these companies do have quite a long track record, or they can have a long track record. And just to throw a couple stats in there to put it in perspective, as of March 2025, there are roughly 250,000 private companies versus 3,000 public companies. So lots of private companies out there to choose from. And I think it's important to note that they're not all small. If we look at companies like Staples, PetSmart, Kohler, those are all private companies. Another stat, I guess, to also put it in perspective would be, it's important to, I guess, the size of the companies is what I'm getting at, is those companies that have $100 million in revenue or more, 80% of those companies are actually private versus public, which only take up 20%. So it's just a great way to diversify away from public markets, especially when you're getting a lot of concentration in those indexes such as the S&P 500.
Is there any more risk in public than private or vice versa?
There's a different amount of risk. They have a common risk. So private markets and public markets both have market risk. However, when we're looking at private markets, it's important to note a few things regarding structure, liquidity meaning how quickly you can move money in and out of investment, and also the relationships with the private equity manager. So when speaking to the structure of the fund, you'll see the term evergreen or drawdown. And so what an evergreen structure means is that the managers of the fund can accept new capital or new money and make new investments on an ongoing basis, which in turn makes the structure a lot more liquid than a drawdown fund. With a drawdown fund or a closed-end structure, those two terms will commonly be used interchangeably. This involves investors committing a set amount of capital. When the manager finds a new investment company, they will make a capital call, which will draw down from the existing investors' committed capital, and these funds do not offer a lot of liquidity. Then if we get to the liquidity portion of what we're talking about, because that's been a pretty big buzzword in our world as of late. So liquidity just refers to the fact when you can buy and sell in the private market fund. So when money can go in or out. But that will be a lot different than what you'll see within a mutual fund, a stock, or an ETF. So those three funds, a stock fund or a stock mutual fund or ETF, are valued on a daily basis. And so their price is set on a daily basis. But since alternatives do not trade on a stock exchange, they're valued differently. So typically by a third-party consultant like KPMG, and their price will be set once every month, once every quarter. It really just depends on the strategy that you're looking at. And so money goes in on a set amount, so on a monthly basis or quarterly basis, but the same can also be said for when you can redeem your capital as well. So again, those are all typically within a term sheet of the fund that your advisor would go over with you, just to make sure you know all of the inner workings and when you can invest and when you can also redeem your capital as well.
With alternatives, what about diversification? How easy is it for you to do that with alternative investments?
Yeah, so alternative investments can provide a great source of diversification to any portfolio. And so I think it's important to note that when you're looking at all the different types of private market funds, they should align with your goals. So for example, if your goal is growth, enhancing your returns, that would lead into private equity. If you're looking for a little bit of cash flow, maybe to minimize some of your drawdowns, that would be more towards private credit or private debt. And then if you're looking towards an upward potential, a little bit of cash flow, you can look at real estate. And then probably one of the biggest ones or the most trending ones that we've seen as of late would be the infrastructure portion of real assets. So infrastructure can provide you with that inflation protection, which has been pretty big recently.
When you're talking about alternatives, you talk about stocks, you talk about ETFs. Does cryptocurrencies fall into the alternative category, or is that something in a completely different animal on its own?
I would say it depends how you define and how you're using cryptocurrency. Because and the reason why I say that is some cryptocurrencies are actually trading within an ETF. So you can actually gain exposure to cryptocurrency through an ETF vehicle. So in that case, that trades on a stock exchange. That would be, in my opinion, not an alternative investment. However, if you're going directly to the actual source, it'd be much like, I would compare it to gold, as you touched on before. Commodities can be considered an alternative. So if you're buying gold bullion, you're buying crypto directly from the source, then that can be considered an alternative as well.
All of this seems slightly more legitimate and maybe even more complicated than purchasing fart coin, that's for sure. So, I don't know where that falls in any of the categories that we're talking about here on the podcast today. Patrick, what have you got to ask or add to with Duran?
I think, the thing about alternative investing is that it is still relatively new when it comes to retail investors. So as Duran had mentioned, something that institutions have been doing for a much longer period of time. Really important to know that in Canada and the United States, is that there are rules in regards to who is eligible to invest in these type of alternative investment strategies here in Canada. So the key word here is an accredited investor. So accredited investor is usually determined by, looking at things like net worth and household income. And so the idea would be is that making sure that people are financially capable of taking on more risk. So that would be a kind of a key thing. As the universe for publicly traded stocks, if it either continues to shrink or stay the same, I think it's important to look at these type of strategies because you could make the case that everybody's kind of chasing after the same rabbit. When you have the stock market as compared to private equity, where we have more options and we can look for look for value. So yeah, those are kind of the what we wanted to talk about today, and so glad to to bring on an expert. So just a couple things before we wrap up is that. So on next week's podcast, we're going to kind of digest this earnings seasons from this week. And then we're expecting to have a budget that we can look at. So we recently sent out an email to our clients, letting them know that we will be doing a post-budget review webcast. I think it's November the 5th. So we sent out that email to everyone yesterday. And as usual, all of our podcasts are located on my website, LinkedIn, and X.
Very good. The Wealth Roundup for the week of October 29th. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. And thank you very much, Duran Guest, for being our guest on the podcast today.
No
Thanks,
problem.
Duran. Thanks, Terry.
Thank you.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.